All right, so since this is me and Terry here, we might get a few more others showing up shortly. Just wanted to go over some of my 2022 trades that we did and their results, and then look at 2023, any slight tweaks we might do, or any type of changing in the strategies. There's not going to be too much changes, I don't think. Let me answer this first question. Yes, I'm generally looking for a way to get 4% monthly without doing zero DTE. That's my goal, to figure out how to increase returns without increasing stress. Okay, yeah, zero DTE is a bit stressful, and you could have big swings. You could make 1-2% in a day for 3-4 days in a row, and then you could have a stop out and you lose pretty much all of it. So notice with the zero DTE, if you get one stop out, you're pretty much broke even for the week if you are closing at the same times that I do, which is around 1.5, 2%. So if you're making 1.5, 2% for 4 days, and on the fifth day you're losing about 6, 7%, pretty much break even, right? So ideally, if you get all 5 in a row, then you have a really good week. You could make 6, 8% positive. But that one stop out could make it break even. And then very occasionally might have 2 stop outs. Didn't happen much this year, but it did happen a few times. So that could be a loss of 5, 6% at least, depending on what your take profits and stop outs are. So one of the best ways, I guess, to go about that would be to try to do longer dated expirations that would have to be at a higher delta in order to make it work, unfortunately. Because if you're looking for the 4% return, you're going to need to have about 85 to 90% win rate, where your winners are higher than 4. Obviously, it has to be about 5, 6%. So you're looking at about a 0.3 premium on a 5 width. And if you can win those 85% or so of the time, and then stop out 15%, that would be pretty close to the 4% there. Now, in order to get the 0.3 premiums, you might have to go 0.12 to 0.15 delta, which is a little bit riskier. Obviously, you're a little closer to in the money. So I might have to do a little bit more in technical analysis in order to get to that point. Terry, do you have any general questions so far?
Yeah, I guess for the zero DTE, I've been doing the 25 wide spreads,
Okay.
and I get basically twice the premium that you get.
Yeah, it's usually around twice.
And I
However, you
was,
are using an extra $500 or so.
yes, I was thinking, instead of doing the 3 times the premium for my stop,
Mhm.
if I got closer to the 3 times of your premium, that would help. It seems like most of the times when it's going against me, you're going to stop out before me. But if I stopped out at the same time,
Yeah,
my losses would be lower.
your losses would be lower. However, your win rate would also be lower because you'd be stopping out a little bit more
That's true.
frequently than normal. So definitely take that into account. But if you want to do it as more of a conservative play, you see how it's starting to go against us a little bit, stopping out early. You would need a lower win rate in terms of like profitable trades in order to have a positive result there. But that's a good thing about it. And another good thing is you won't have massive losses if you're waiting out for the 3x stop. Yeah, something to consider. Another thing I was looking into is possibly just doing an alert price, where if it's 15, 20 points away from your sold put or call, once it touches it, get out. That won't necessarily be a 3x. It could be more. It could even be less depending on when on the day that happens. Hi, David. How's it going? You can unmute your
Doing all
mic.
right, Lance. How you doing?
I'm great. It might be us 3. I'm not sure if anymore. So,
Okay.
middle of the weekend on an afternoon, it's hard. I try to do random times, sometimes in the evening.
Sure.
If I'm free in the day, sure, and weekends. So try to get
Yeah.
at least some opportunities for everybody to possibly show up.
Right. I'm still doing your wheel thing with AMC.
No,
Unfortunately, it's been dropping quite a bit lately.
yeah.
Now I've got like 525 shares of it, with an average of like $6.17, something like that. So
Okay.
I'm looking down the pike to see, what's the best thing I should do with it. I'm thinking, I'm kind of waiting to see what's going to happen maybe this coming week to see if it makes a turnaround. But I could do 5 contracts on, I think February, was it the 17th or something like that, where I think at 650, which would give me, I think, $100 in premium, which I didn't think would be too bad unless it obviously turns around and goes above 6 or something like that. So I
Yeah,
might just wait
but
till next week.
if it does go above 6, you would at least get out at a slight profit. So,
Right, right. And in my understanding, after looking over all the notes I took and what you helped me with earlier this year, at first I was thinking I only got to keep the premium, but I do keep the premium plus whatever over my cost basis is and what the strike price is, correct?
yeah, well, over what you actually bought it at. So your cost
Right.
basis would be wherever you got your sold put. So I guess you sold the put at $6, I'm guessing. And then you got assigned on it.
Well, no, I actually just kept buying up shares. And
Oh,
so I
okay.
was doing a covered call in the
Okay, so
past.
you're buying the shares, you'll just find the total amount that you spent divided by the number of shares you have. And that would be your cost basis. From
Right,
that number, you can start subtracting the premiums you receive. So another way you could do it is just look at the total amount you spent, subtract the premiums then, like right away. Whatever that number is, divide by the number of shares. That's probably the easier way to do it. So it's essentially the money that you spent, took out,
yeah,
minus the money that came in through premiums. That's the total amount you spent. And that's how you get your cost basis. So yeah. If you do sell you sell a covered call a little bit above what you bought your shares at, then you would have some capital gains as well. So if
right,
you're a little bit
right.
more
That's what I
bullish,
figured.
if you're a little bit more bullish, you could sell the $7 or even $8 strike price and then make a little bit in capital gains. Let's look
Right,
at some of the possible numbers. The February one sounds okay. The weekly expirations, so not the 17th, but like the 10th and the 3rd, those
yeah,
have the 0.5 strikes. So if you look at the February 10th, for instance, has 6.5, 7.5.
right,
The 3rd Friday of every month for AMC doesn't have the 0.5s.
right,
Not
right.
necessarily the end of the world, but just a FYI on that. So you
I
can,
think maybe it was a 7 I was looking at then.
yeah, the
I
7
think
will
there
pay at
was,
least 20. So if you have 5 contracts, that'd be $100. You're right on that.
yeah, I believe that's the one I was looking at. And the delta was close to 0.2 at that
Yeah,
point.
0.2, 0.23 or so. So that's a
Uh-huh,
reasonable way to go because it is
uh-huh,
paying a decent amount in your premium. If you're making $20 divided by the 6 for $600 premium, you're making 3% on your money
uh-huh.
in 40 days or so. That's still a pretty good return. And if it goes past 7, you'd get a little bit in capital gains as well.
Right, right. So I'd make what, another
$90 or so.
$250 or something on top of that, maybe?
Yeah, it
If my
depends on
average,
what your average cost was per share.
I think my average is like $6.17 is what all the shares together.
So then it would be another
average out.
$83 per 100 shares.
Right, right.
If you do 500 shares, that's a good gain. You'd make about
Yeah.
$400 or so.
Okay.
Now we have
That's
Aaron
good.
showing up too. Any other quick questions on AMC or any other positions that you have?
And the only thing I'm still waiting on is Recon to get back where I bought it at a year and a half ago.
Oh,
And
yeah.
I can't even do anything with it. It's
Yeah.
ridiculous.
There's no option chain pretty much that exists. Like there's no volume on it. You don't have to wait.
Right. Yeah, it's increased pretty good lately. It got up to like $1.32, and I need to get it up to $1.42 before I can get out of it,
Okay.
which is pretty close now.
Yeah, let's get in there. Well, good luck
Yeah.
on that one. There's not much else you can do, but hope that it bounces up.
Right, right.
Hi, Aaron. How's it going?
All right, how are you?
Good. Do you have any general questions so far? We're just leaving for Q&A right now.
Oh, just waiting for a Q&A. I think I just had a few quick questions, that's
Yeah, go
all.
ahead.
Oh, okay. As far as what do you think is, I mean, if I was to go to a platform, right now I don't have well, I do have Thinkorswim, but I'm not sure how to utilize that. A question I had was, as far as finding delta and implied volatility, what's the best platform to go to if you don't have an account there already?
Okay, if you don't have Thinkorswim and you're not willing to use it, let me see. There's one site that has the approximate delta, but it doesn't have implied volatility that I'm aware of. You probably have to go to a second site on it. Let me-
Okay,
I was looking at it recently, stopoptionschannel.com. I'll put this on the chat.
okay,
But this one, I did start using it a few years ago when I was first looking at quicker ways to look for premiums and whatnot. Where's the chat? Here's the chat. So for instance, you enter any symbol, I don't know, Verizon, for instance, it could be any symbol you want. You could look at the expiration dates. And then you could either want to sell covered calls, so you already own the 100 shares and you want to sell the covered calls against it, or you're looking to possibly enter a position on a cash secured put. It's
Okay.
called a cash covered put, it's the same thing. So
Uh-huh.
for instance, Verizon, let's say I wanted to sell a cash secured put here. It does say the approximate delta. The delta would be the column right here in green, the odds that it expires worthless, okay?
okay,
So that's essentially the delta. Verizon's at 39.40. You go near 39 or so, it's 0.58. So a 58% chance that it would expire worthless. You would do 100 minus that to
Mhm.
find the delta. Okay.
okay,
So 100 minus 58 would be 0.42 delta, which sounds about right because it's pretty much at the money, right?
Yeah.
What's neat about this one too, it does tell you what your yield is, like how much money you're making divided by the total amount you're putting up. And it does
Right.
annualize it too. That's pretty neat.
oh, wow,
But it doesn't show implied volatility. You would possibly want to just type in the symbol and implied volatility. There are some websites that show it. Market Chameleon I've seen before.
Mhm.
I think they might show the implied, it shows implied versus historical. So there's another site you can consider. I haven't ever done the paid version or any of that, but the free version does say the actual numbers at least.
okay,
So the IV is at 17.5, 27.1 for Verizon, for instance. And if you picked a much more volatile stock, it would tell you the number.
all right,
Yeah, so those two websites would show you it without needing any brokers at all. You can just do that on the internet on just websites.
okay, great, thank you.
Any other questions, or Terry or David, any other questions?
Not at this point.
Okay, Terry, any questions you have?
Yes, I did, but I don't know how to get back to them. When you do your futures weekly MES,
Yeah,
can you just go over the different, what's the BP and I'm looking,
Okay.
I'm saying, I'm not quite sure what all these things
yeah.
are.
So let's look at, say, MES futures. This is the micro E-mini future for S&P 500. What I typically do is I look around a month out, so 31 days out. We'll do the next one probably Monday evening, I'm guessing. The futures should open. It won't be open tomorrow because the markets close on Monday. So I typically look around a month out, 31 days. And then I'm gonna look for a delta of between 0.03 to 0.05 in most cases. I usually want to take in at least 5 in premium. So I'm gonna look at the bid prices. Obviously, right now the market's closed. It's not gonna show too much data. But if you look near the 3,400 level, the bid's at 5. So there's a good chance you would get at least 5 on this particular option. Okay.
Yes.
So if I sold, right now I'm on the paper trading for Thinkorswim and I have no futures on there. So this would be the base level buying power needed. As you'll see, and I'll show you shortly, it changes a bit if you have other positions. So let me just sell the 3,400, make it a nice even number. And let's say I could get 3.5 or so. Might be higher, but we'll just go with that number. Okay. That's probably 4 actually. Because the numbers will change. All right, so if I sold that for 4, I would get $20, 4 times 5. This is a 5 multiplier. And then the buying power is 419.50. Okay.
Okay.
So this is the initial amount of money you would need in your account to enter the trade. Now, if MES stays really high up, 3,800s, the buying power probably won't change at all. It actually might go down a little bit as you get closer to the end of the month. Okay.
Okay.
Because what the buying power is showing is essentially looking at the amount of risk in that particular position. And they're going to factor in what are the odds that it could drop all the way below 3,400. Initially, with a month out, there's a good amount of time for it to drop. So that's why the buying power is around $400. If it was at, say, 38.68 with a week left, the buying power might only be $100 or $200 because there's less time for it to go down. That makes sense?
Mhm.
So the issue is sometimes this buying power could go up higher. And I'll show you a way to do that. So at 3,400, it costs about $420. If I sold the 3,800, pretty close to in the money here, it's using up $925. The reason for that is it's a lot easier for it to get assigned, and then you would have to own the contract. Okay.
Okay.
So as the contract gets closer to your strike price, if it starts dropping a bit and we sold the 3,400 and it gets to 3,500, 3,600 or so, you might need about $900 in order to have the trade in play for your buying power. Okay.
Okay.
So in general, I usually recommend $1,000 total. So it's about $400 to start the position. Have another 600 or so in cash and don't trade it. Just leave it in your brokerage account.
Okay.
Because if MES starts to drop and go against us, it's going to need more buying power and you don't want to get margin called. That's where they're saying you don't have enough funds available for your trades, right?
Right.
So in general, $1,000 per spread is usually okay for MES if you're doing it with, say, a sold put. What's interesting though, if you do it through, say, Thinkorswim, I'm sorry, Tastyworks, Tasty Trade, it considers the other positions you have in play in order to figure out your buying power. So right now on the Tasty account, I have quite a few strangles on MES. I have 1, 2, 3, 4, 5 strangles, right? Now let's say I just sold a put around 3,400, 1 month out. Remember in Thinkorswim it said $400, right?
Right.
Let's see what it is. I don't know what it is right now. It might be around the same. We'll see. Oh, it was actually a little higher, $500. It's interesting. I think the reason why I did that is because I have some calls in play also. So what I could do is maybe make it into a strangle where you sell a short put and a short call. And we'll go around the same delta, 3,400. When Thinkorswim, let's look at the call side delta around 0.05 or so. Let's say around 4,020 or so. If we go to 4,020. It's going to be pretty close to the initial 500 that you saw before, I think. It actually went down. So 467. Stand margin is really weird. They're saying it's less risky in terms of my buying power to add on a sold call than it was just to sell the 3,400 put by itself. Which obviously it can't be less risky because now I could get called away on the call side too, so. It does weird stuff. That's why I leave a lot of cash on the side and you're usually good, okay? Does that make sense, guys? Here my net liquidating value, if I got rid of all my trades, I would have about $13,500. I'm able to trade with $7,600 more if I wanted to, which is a little bit less than 50%, right? So I could easily have entered that last trade and then just keep entering over and over, maybe like 7 or 8 more of them. Tastyworks would allow me to do that, but I'm not gonna do that because any slight movement in MES, I could get margin called like that, okay? And that's why we don't wanna do that, okay?
Can that be done in the IRA account?
IRAs, I think in Tasty they let you, but I would ask them about it. Tastyworks is very flexible and very loose in what they allow you to do. So I would ask about it, and I was considering doing that, but I'd rather keep my Roth IRAs where they are. I have it at Schwab right now. They may or may not. I'm not sure if they let you do the naked call side. They might let you do the naked put though. Any other questions from any of you guys, or I'll just look at some 2023 goals of mine? Maybe-
I got a couple, real
Sure.
quick. I know what you had told me in the past, when doing a covered call to look for like a 0.2 to 0.3 delta. Now, do you combine that with, looking at open interest as well? And
Yeah.
how do you work that in? When you
Yeah.
make a determination?
Good point. I would like to try to sell options with a large amount of open interest and volume for the day, if possible. So if it was between, say, a $6 strike and a $6.50 strike, and one of them had a lot more open interest than the other, I probably would just trade that one.
The one that
Um,
has the more open interest?
Yeah, because the bid ask spread, that's the difference between how much the bid is and the ask is. If that's very wide, you kind of lose a bit of money on those because
Yeah.
you may not know where you're gonna get filled at. But if you have a lot of volume and open interest, if it's the bid ask spread might only be $1 or $2, then you're pretty sure you know what you're gonna get. Like
Okay.
AMC is a pretty liquid stock. There's a lot of people doing options on it. So I wouldn't
Yeah.
worry too much about it. But if
Okay.
there's a smaller stock that doesn't have a lot of trading going on, you could get really screwed on those bid asks. It could be $15, $20 sometimes.
Wow.
Yeah, that's a
Okay.
good question. So,
Great.
yeah, again, I lean on the open interest, but if you look at both of those for AMC, I would just pick the one that you're comfortable with the possible returns if it hits the strike price and not really worry about the open interest too much. So
Okay.
right now, if I go all the way to that February 17th expiration, the $6 call had 3,000 open interest and the bid ask spread is only $2. The $7 one had 15,000 open interest, so a lot more.
Yeah.
But the bid ask spread is $6 for some reason. Again, the market's
Oh.
closed, it could be a little different right now.
Yeah.
But I would think it would have been about $1 or $2 anyway.
Okay.
So I wouldn't make it, if the open interest was 0, then I wouldn't pick it at all. If the open interest has a decent amount, like a few hundred for the day, and it's like
Mhm.
middle of the day, then it's usually okay. And just go with whatever your target profit would be.
Okay.
So in general, remember when you're selling a covered call, if you sell it at a higher strike price, you're gonna get less premium, so less current income coming in, but the
Right.
possibility of getting more capital gains if the stock rises a lot.
Right. Right.
There's not really a right or wrong answer to what strikes to use there. It's really up to your personal preference in most cases.
Yeah.
I usually like to take in more current income, so I'm willing to go lower in the strike prices.
Right.
Like my main goal is 2% a month, so if I'm able to get the 2% on a relatively low strike, I'll do it there. So
Uh-huh.
it really depends, but there's no right-
As long as the, your strike is above your cost basis, obviously.
Yeah, and then unfortunately, if a stock drops a ton and you're not able to sell them at your cost basis, that's where it gets a little interesting, where your price
Right.
is trying to break even, or
Yeah.
possibly get out at a small loss.
Yeah,
And that is gonna happen occasionally. Not every trade will work out. Ideally,
Mhm.
that happens with a low percent of your overall trades. And you
Mhm.
have a lot of, and that's the main reason why we were doing our Keskiard puts. We buy to close them early. Cause I don't wanna be holding a lot of these like slightly meme higher IV type stocks. Does that make sense?
I wasn't sure the last thing you said about the puts. What did you say about,
When I'm doing the Keskiard puts and the recommendations every day.
oh, cash
Yeah, I like
secured
to buy
puts?
to close them pretty early. Because I'm
Okay,
stuck holding these individual stocks. Like you might get a really good return if you let it expire worthless. But if it doesn't expire worthless and you're holding the shares, you could get stuck holding a lot of different stocks that you may not necessarily want to hold. And then
yeah,
it gets tricky and you might have to just close some for losses.
okay. I probably need to take another look at cash secured puts since I've been doing the covered calls so often. I haven't
Yeah.
focused on anything else.
And there's nothing wrong doing them with covered calls. If you like the stock
Yeah.
anyway, just keep accumulating shares. When you have enough
Yeah.
for 100, sell a call against it. There's nothing wrong with that at all. You know,
Uh-huh.
especially if you think the stock is already like fairly priced or even cheaper than it should be.
Mhm.
Might as well just buy the shares and sell calls against it.
Right, right. Okay, thanks.
Yeah, no problem. I want to quickly go over some of the 2022 numbers here. And I did leave the PowerPoint on the, I think it was the general tab. One of the main things I want you guys to notice with this data, I don't know if I'm sharing my screen or not. There we go. I did that by mistake the other time with a Zoom call, I think, where I was just talking and I thought I was showing my screen the whole time, but I wasn't, and people had no idea what I was talking about. All right. One of the main things I want you guys to notice is law of large numbers works out in our favor. If you flip a coin and you're trying to guess if it's heads or tails, right? It might turn up 4 heads in a row. And the coin could be completely normal coin, right? It's a pretty low chance of happening, but it theoretically could, right? But if you flip a fair coin, say 100 times, you're not going to get 100 heads in a row. The odds of that are insanely low, right? So the more you flip the coins, the more it ends up being close to that 50-50, 50% heads, 50% tails, right? So the thing I want you to consider when you're looking at all this data is I do most of these trades. Whenever I have funds available, I do enter at least one contract. And I do about 80% of all of the trades here. Now, that might be more than what most of you guys will do, but just to be aware, the more trades I'm doing, I'm flipping the coin more, and I'm going to get closer to these average returns. If you flip the coins less and you're only doing a few positions, you might get a really good return. Maybe you guessed right on the heads, tails, like every time. But if you happen to be wrong once or twice, it could be a pretty dramatic loss, right? There's a lot of variation in lower sample sizes. Okay? The credit spreads this year, these are the longer dated 30 to 45 days out in general. We had an average return of 2.7%, and that includes all of the losses. So when we're starting our trades, we're usually starting around $20, $25 and a 5 with. $25 would get you 5%. Obviously, some stop out, but the average return was still positive. 2.7% in about a month. It's a really good return, I think. Did 170 wins out of 193 total. It's an 88% win rate. This was the data of every trade in terms of what happened. The last few were for January. You can see a lot of them are between that around 2 to 8% in general. And you do have some losses. The losses do sting a little bit. This month right here, it was in August, and this month right here in March were the only 2 months where we lost money on this strategy. The other ones, you saw a lot more winners than losers, right? What's interesting is that 88% win rate aligns with the deltas that I've been using. Almost every credit spread was 0.08 to 0.12 delta. And then if you have a 0.08 delta, that should be about a 92% win rate. 0.12 delta, 88% win rate. So I found it very interesting how the win rate was very close to what the delta said. In general, you usually want to let them to go near expiration. If you buy to close them at 50% profit or so, you need to have a higher win rate to make it work out. For the premiums, I've seen a lot of trades where you can get about $15, $17 in premium. Doesn't seem worth it based on this data. I think you need at least $20 in a 5 wood. Okay. And now stopping out at alert prices do keep you in the trades longer. It could be slightly more than 3x the premium received in your stop out when you do the alert price. However, I think it's worth it in general for most cases, especially if the stock is still pretty far out of money. Cascade puts these with a longer dated, a little bit higher implied volatility. I want a very high win rate on these because I don't want to hold a lot of these stocks in the long term. Average return 2.26%. I think I did the data is around 18 days was the average amount of days in the contract. We had a 90% win rate there. This was a higher win rate because we buy to close them early. We're able to get out of the trades at the 50% profit to make that 2-3% that we want. Okay. It might start to stop orders for the high IV. So if the IV is really high and I really don't want to hold the stock in the long term, we might start stopping out on a few of these. If you ever see that little red dot next to a CSP, I'm probably going to put a stop price there because you don't want to be selling a put at say 10 on a really garbage stock, get a sign and it just keeps dropping and dropping and the stock's at 2. It's really hard to get out of that case. Okay. So we might stop out before that happens. Here's a cascade puts. There's none of the negatives because a lot of these we had to wheel in the bottom, so I just showed it as a 0. You can see a large amount of the data do show these positive expectancies. Futures was a 100% win rate this year. We're looking for a pretty low 2 to 3% per trade on these. The 26 trades and all of them worked out. Average return 2.68%. This is one of my go-to strategies that I'm going to continue for next year. Staying with those naked puts and possibly add strangles to them. I like the strangles in general. You add the call side to the put because you bring in a little bit more money in it. I didn't need to roll or manage any of them. Even in a very volatile 2022, we didn't have to worry about getting a sign on all of them. There were a few that were pretty close near the middle of the year, but they never actually got signed. Leave at least $1,000 for one contract. Just like we showed before, it might only use up $400, but don't over leverage and do too many contracts. Spam margin could get you really badly. Staggering funds, meaning doing one every week and then spreading out the strikes, does help spread out the risk. So you don't want to overdo one particular week and then wait. If you have enough to do, say 4 total contracts, you have $4,000 in there, you probably want to do one every week because if the market drops a bit from the first to the second week, the next week's strikes will be even safer in the put side. If it goes up a lot in the first, second week, your call side the next week will be higher up. So it definitely staggers it out. Then 0 DTE, the average return was only 0.42%, but it is a day trade. There was quite a few stop outs near the end of the year, but we still ended up with 86% win rate. It was 172 out of 200 total trades. We're gonna next year look at $1,000, but we did start with 500 beginning of the year, so I kept it at 500. Would have turned into 765, so really good total return for the year on it. But again, there's a lot of swings when you have those stop outs, right? Taking profits at the 1.5 to 2% does lower your stop outs. Some people try to get a little bit, I wouldn't necessarily say greedy, but they try to stay in the trade longer and then they are stopping out later in the day. Consider around that 1.5 to 2% as a good initial point to stop out, and then you don't have to worry about the trade the rest of the day. And I'm going to consider alert prices for next year where we don't necessarily stop out at 3x, but we might stop out at a certain number of points away from the strikes. Some goals for next year, at least for me, I want to be more conservative in my cascade puts and covered calls, especially in the Roth IRA. I'm gonna look at more dividend growth companies, dividend achievers and aristocrats and whatnot have lower IVs. I'm still gonna be using some of the higher IVs, but just a lower percent of it. Gonna be working on a psychology of investing. One of the biggest issues with investing is the thought processes. Like you might be in a good trade, it starts to go against you a little bit, and then the psychology, you start overthinking it and you freak out, and you might get out of the trade too early in some cases. In other cases, you stay in the trade too long because you think it's going to turn around and then you get it really hurt. So we're going to work on different strategies to deal with those things, and going to continue on the blog. And that's about it. And if you guys have any questions about what I just covered in that PowerPoint, we only have about 3 minutes left.
Did you do any of those oil futures?
I did a
Like that.
couple of the MCL micro
Mhm.
oil future. I did some of gold too, the GC, but I did
Oh.
those as credit spreads. I will continue to do a few of those from time to time. I think it's good to have a little diversification in your futures. Excuse me, but for every about 4 or 5 MES, maybe you could do one of the MCL or GCs.
Mhm.
Where does your blog show up?
It's on the general tab. I'll look later and send it over. I think I put it in general. Or I might have put it under blog. I'll just send a link on the chat.
Okay,
Yeah, I've been trying to put stuff into the datatraders.blog a little bit more. Just so it's a good way to type out what I'm saying and have it all in one place. All right, if you look in the chat. Any last questions? Got about a minute left.
Oh, I just wanted to let you know, Lance, that I did apply for the futures IRA in E-Trade, and they did approve, but it does take a 25,000
Yeah.
minimum.
Yeah, that's a lot. E-Trade wants to be sure that they're safe with their members. Tasty Trade, they'll let you do it with like $2,000-3,000. It's pretty crazy.
Yeah,
But
so I might have to move something over to Tasty Trade at some point this coming year and start, do they let you do in Tasty Trade a fake, a paper trade?
Thinkorswim, you have a paper trade. Unfortunately, Tasty doesn't do it.
Okay. All right. Yeah, I gotta figure out Thinkorswim. It just looks like a chart to me, so I don't know how to do anything on Thinkorswim. I imagine they have like little.
We'll be more in touch in DMs and whatnot, and we'll figure that out next year.
Okay.
All right, guys, we gotta get going. The Zoom's about to end, so have a good
All right.
rest. Happy New Year's.
Thank you.
See
Happy
you
New
as
Year.
well.
guys.
Thanks,
Happy New
Lance.
All right,
Thank
thanks
you.
for joining in.